Most traders think price moves directly toward major liquidity, but smart money follows a completely different path. Before reaching external liquidity, price often uses internal liquidity as stepping stones along the way. In this video, I'll show you exactly how smart money delivered price from internal liquidity all the way to its final target. Watch till the end because this concept can completely change the way you read the market. And if you find value in this content, don't forget to like, subscribe, and comment below. First, let's identify the sell-side liquidity, or SSL. As you can see, multiple lows were resting at this level, creating a pool of liquidity below the market. Retail traders often place their stop losses beneath these lows. Smart money knows where that liquidity is located, which is why price eventually moves into this area before revealing its true intention. Now pay close attention to what happens next. After taking the liquidity below the lows, price suddenly pushes higher and breaks the previous swing high. This break tells us that buyers are stepping into the market and gaining control. Instead of continuing lower, the market is now showing signs of bullish strength, which is an important clue for what smart money may be planning next. At this stage, the market creates what many traders see as a perfect buying opportunity. Price forms a temporary low and starts moving higher, encouraging traders to enter early or place their stop losses below that low. This creates a fresh pool of liquidity in the market, but instead of moving directly to the target, smart money first takes that liquidity, clearing out weak positions before continuing the real bullish move. Once the inducement liquidity is taken, the market gives us something very important: a bullish order block. This zone represents the area where strong buying pressure entered the market and pushed price higher. Instead of chasing the move, I mark this area as a potential point of interest. At this stage, I'm not looking for an entry yet. I'm simply identifying the zone where smart money may step back into the market. Before looking for any confirmation, I always want to know where price is likely to go. In this case, the most obvious objective is the liquidity resting above these previous highs. Many traders have stop losses, pending orders, and breakout entries sitting in this area, making it a valuable target for smart money. So while the market is currently trading much lower, I already have a clear destination in mind. My expectation is that if buyers remain in control, price will eventually be delivered toward this external liquidity. After identifying the bullish order block and the external liquidity target, the next thing I want to see is price returning to that zone, and that's exactly what happens here. Instead of moving straight to the target, the market pulls back into the order block, giving us a chance to look for confirmation. This is where patience becomes important, because entering too early can lead to unnecessary losses. Now let's zoom in and see what clues price gives us inside the zone. Now, when price reaches the bullish order block, something interesting appears on the chart. If we zoom in, we can see a bullish Harami candlestick pattern forming inside the zone. According to candlestick analysis, this pattern can signal that selling pressure is weakening and buyers may be preparing to take control. However, this is where many traders make a mistake. They see the pattern and immediately enter the trade. Personally, I don't use this as my entry signal. I treat it as a clue, not a confirmation. It tells me to pay attention, but I still need stronger evidence before risking my capital. So instead of entering here, I wait for the market to reveal its next move. Then the market gives us the clue I've been waiting for. Notice how price suddenly moves away from the order block with strong bullish momentum. This aggressive move is known as bullish displacement. Unlike the bullish Harami, which was only a clue, this move shows real buying strength entering the market. Buyers are no longer reacting quietly, they're actively pushing price higher. For me, this is a much stronger sign that smart money is defending the order block and preparing to deliver price toward higher liquidity. At this point, the market provides the confirmation I've been waiting for. After the bullish displacement, price breaks a short-term swing high and shifts the market structure to the upside. This tells me that buyers are now gaining control and the previous bearish flow is losing strength. Remember, the bullish Harami gave a clue. and the displacement showed momentum, but the market structure shift adds confirmation. Now I have multiple pieces of evidence aligning together, which significantly increases the probability of a successful bullish trade. With the market structure now shifting to the upside, I finally have the confirmation I was looking for. Instead of buying blindly from the order block, I wait for price to prove that buyers are actually in control. Once that confirmation appears, I can confidently look for an entry. This approach helps me avoid unnecessary risk and keeps me aligned with the smart money narrative. Now that we're in the trade, the next question is simple. Where is price most likely to go next? Now that I'm in the trade, my focus shifts from finding an entry to managing the position. The first area I'm watching is this internal liquidity resting above the recent highs. These highs may not be the final target, but they still contain liquidity that the market is attracted to. As price continues moving higher, it begins delivering exactly as expected and starts approaching this level. This is the first checkpoint in the trade and an early sign that the bullish idea is working as planned. Notice what happens once price reaches the first internal liquidity target. Instead of rejecting from this level, buyers remain in control and push the market even higher. Price successfully breaks through that internal liquidity, which is an important sign of strength. If the market were weak, we would expect a reaction or even a reversal here. But by breaking this liquidity pool, price confirms that it still has bullish intentions and may continue its journey toward the next liquidity target, resting higher in the market. Now the concept becomes even more obvious. After breaking the first internal liquidity target, price continues pushing higher and begins attacking the next pool of internal liquidity. This is exactly how liquidity delivery works. Smart money isn't focused on a single level, it's focused on the entire path. The market keeps moving from one liquidity pool to the next, collecting liquidity along the way. Each internal liquidity target acts as another stepping stone, bringing price closer and closer to the larger objective waiting above. And finally, price reaches the external liquidity target that we identified earlier in the analysis. This is the destination smart money was aiming for all along. Notice how price didn't move there in a straight line. Instead, it used internal liquidity as stepping stones, moving from one liquidity pool to the next before reaching its final objective. This is why understanding liquidity delivery is so powerful. It helps us see not just where price is, but where it wants to go. Before ending this video, I want you to remember one important lesson. Most traders focus only on entries, but smart money focuses on liquidity. In this example, price didn't move randomly from the order block to the final target. It was delivered step by step, using internal liquidity as stepping stones to reach external liquidity. Once you start viewing the market through this lens, you'll begin to understand why price moves the way it does. If you found this concept valuable, make sure to like this video, subscribe for more smart money content, and comment below what topic you'd like me to cover next.